What is bond? And how it works? We learned that a bond is nothing but a loan. One way for a company to borrow money is to issue bonds through a bank. The bank merely acts as the mediator and is responsible to find buyers for these loans that are broken down to small pieces. These investors are simply bond investors. The investors receive money back from their investment typically twice a year. The biannual payment is determined by the bond's coupon. If the bond is a 5% bond, the return from the bond is simply 5%. We also learn that not only corporations, but local governments and even the Indian government use bonds for the same reason. Simply put, it is a source of funding. Bonds are subject to company and government failure. Basically, this means that if the company defaults, the investors will not get their money back. In general, the Indian government is considered 0% risk because they can just print more money. Other risks include interest rate. Moreover, we learned that bond investors are the first to receive payment if there is any money remaining after bankruptcy. Conversely, common shareholders are the last to receive payment and seldom gain anything. Finally, we see that bond investing can be expected to be even more profitable than stock investing when the market is high. Typically, bonds are cheap when stocks are expensive and vice versa. Key points to remember. Bond. A bond is no different from a loan. The bank is a mediator that can ensure that a corporation or a local government can borrow large amounts of money, break the loan down to small pieces, and find multiple investors for them. Coupon rate. This expresses the amount of money the investor can expect to get back from the investment. If the bond is a 1000 Indian rupee bond issued at 5%, the coupon rate is simply 50 Indian rupees. Typically, the bond investor will receive 25 Indian rupees biannually. Par value. The par value is the small piece the bigger loan is broken down into. For instance, if it's 1000 Indian rupees, the investors pay 1000 Indian rupees for the bond. In reality, they might pay 1005 Indian rupees because the 5 Indian rupees is a small fee to the bank for providing the loan. Such a fee is called an underwriter's fee. Leverage. The amount of debt used to finance a company's assets is known as the leverage. A business with significantly more debt than equity is considered highly leveraged. Muni. This means municipal bond. A municipal bond is a bond that is issued by the local government. Thanks for watching.